cheap. But where this gets interesting is if the stock gets extremely cheap and they're able to deploy capital and earn a decent rate of return, the market cap is so small and the valuation is so low on this company. When we look at the total addressable market coming up in the next 5 to 10 years, I think there could be some underlying value here. So in this video, we're going to talk about a contrarian AI play that has a decent valuation when we compare it to a lot of the other companies that are out there. Now, HPE is definitely not a sexy name when it comes down to AI. The stock usually trades between $13 to $16 a share, and with the recent AI talk hit as high as $18 a share, but then revenue guidance came out and the market was unimpressed with this. But let's hear what the CEO has to say.
In the red right now, having their worst day, in fact, since May, after the company issued disappointing earnings guidance for 2024 at its analyst meeting. Because, I don't have to tell you some of the reaction, lower than expected earnings and free cash flow guidance, according to here, I think Barclays.
We're going to see double-digit growth in AI, double-digit growth in the intelligent edge. And at the same time, our free cash flow conversion is improving. Because next year we're improving by 10% when you exclude the $200 million from the H3C execution.
Are you having trouble convincing investors that you're an AI play?
No, remember we have 3 growth engines in the company. One is the intelligent edge, which is growing at 50% year over year. That we expect that to continue to grow double digits. And that to us is core because it's generating the largest profit in the company. Hybrid cloud for us is HP GreenLake. I want to call it the 4th cloud. And fundamentally, that business now is growing 40% plus. And then we have AI. And AI this year is going to grow very nicely, double digits. We reaffirm double digits going forward. And it's a big opportunity for us because we have a unique platform, which is inclusive of infrastructure, software, and services to run these large AI scale models.
So HPE has been around since 1939. It really works in 6 core areas. And in these 6 areas, the 2 that really I want to highlight is going to be storage and AI. And that's where I think their total addressable market is going to start expanding. Now, I want to be completely transparent here. This is not really a sexy company. When we look at revenue just steadily deteriorating here, doing $31 billion of top line revenue in 2015, and in the trailing 12 month doing right around $29 to $29.5 billion of revenue. But when we think about where demand is picking up for a lot of businesses, it's going to be supercomputing, storage, and AI implementation is where I think the biggest value for HPE can be added to a lot of businesses that are out there that want to be more efficient, want to cut costs, and want to overtake their competitors. Now, I realize that this company has done pretty much nothing for the last 20 years. And so when there's all this hype about AI, you would expect a company like this to have really strong growth and really strong forward growth. And in the call, we can see that it looks like it's going to be slow growth for the next couple of years, but there's an opportunity for 4 to 6% growth there and beyond. And especially when he talks about the total addressable market expanding here, makes it an interesting deep value contrarian outlook for an AI play. This is a company that's been around for a while, fairly responsible with their money, has cash flow, and the fundamentals are actually decent. And so I don't think you're taking on a tremendous amount of risk with building a position in a company like this. I think the question becomes at what price point does it make sense? And that's what we're going to talk about here. So we can see the reason why the stock is selling off is that the forecast dipped down for HPE, going from an expected $2.15 of adjusted earnings down to basically $1.82 versus $2 roughly. So I'm going to use $1.90 here. Currently, the stock is trading just around $15 a share. And if we divide that $15 a share by 1.8, we get roughly 8 times earning. For a company that could be growing 4 to 6%, this seems very, very reasonable from the outside, but we're obviously going to dive into the numbers a little bit better here. I just want to get an idea what forward earnings are going to be versus its growth rate. We talk about PEG ratio. Ideal PEG ratio is 1 and below, so we'd like to see like 8 to 9% growth rates on the company. But with that being said, if the stock keeps selling off and we get a forward PE of 6 to 7 and they can grow 6%, well, we get a PEG ratio of 1 on a pretty interesting company here that has AI capabilities. So just a contrarian thought process here that I'm sharing with you. So in 2024, they are now guiding for roughly $29.1 billion of revenue. So we're going to bump this down just a little bit. And so we have them doing $29.1 billion of revenue in 2024, growing to a slow, steady pace of $30 billion in 2025. Where this gets interesting, as the CEO stated, is that the 4 to 6% revenue growth that could come because of outperformances in certain aspects of their business model, that can really generate some growth here and actually grow margins as well. But we're not going to even take that into the equation. We're just going to talk about revenue growth. We're going to keep margins where they are currently. Total debt is sitting just under $12.5 billion. This is a company that does $1 to $2 billion of free cash flow, and they roughly have $4.1 billion of cash on the balance sheet. Obviously, I don't think this is the cleanest of balance sheets, but I don't think it's awful either. And we can see here that the free cash flow has been flowing in just over $1 billion of free cash flow consistently, and as high as $3.3 billion of free cash flow, but we're going to use this $1 to $2 billion free cash flow as a jumping off point. Now, I do want to point out the fact that the company is paying roughly a 3% dividend, and they've been paying that dividend for roughly 7 years with no growth behind it. So let's talk about a few different things here. Number one, the balance sheet is not perfect. Okay, it's okay. I think they can manage the debt that they have. I think that the balance sheet, I think the free cash flow and the cash that they have is substantial enough to handle the balance sheet. I also would like to see this company kind of get more aggressive on maybe some mergers and acquisitions on some of these smaller cap companies that have some interesting business models that can already complement what they're currently doing. You know, a big acquisition that comes to mind is definitely Cisco and Splunk deal. I would like to see HPE do a deal like this. Obviously not as big, but something similar that can complement their business that adds some additional revenue growth to their top line that's growing already around that 4% mark. And when we took a look at the overall valuation from a PE standpoint, it is very reasonable compared to its peers. The stock is cheap, and it's cheap for a reason. As I stated, they're not getting a high return on deployed capital. They don't have really strong revenue growth. So there's no need to really pay a premium for this type of company. But where this gets interesting is if the stock gets extremely cheap and they're able to deploy capital and earn a decent rate of return, the market cap is so small and the valuation is so low on this company. When we look at the total addressable market coming up in the next 5 to 10 years, I think there could be some underlying value here where they can actually outgrow analysts' expectation. To me, this is a company that could just be at the right place at the right time. Of course, this is all speculation, but my goal here is just to get a fair market value, and everything I'm talking about above and beyond what they're able to do is really just my ideas. I'm still going to use low growth rates as if none of this is going to happen. We get two prices here. We basically get an $11 price target, which gets us a price target of roughly $13 to $14. And so personally, I think anything under $14 becomes very interesting. And this stock is hitting anything from $9 to $10. And that's where I think this gets very, very interesting from a very low risk to high reward company that pays a dividend and has that AI exposure. When we look at a $19 billion market cap on a company that can free cash flow anywhere from $1 to $3 billion, is basically trading at a forward PE of 7 to 8 times earnings. And we can see here from an EV to EBITDA multiple, we get between a $13 to $14 price target. That's basically fair market value. It's pretty close, in my opinion, to being fair market here. And I think when we adjust for the total addressable market that's coming in the future for this company, obviously the over 3% dividend is icing on the cake. But overall, I think this is a pretty interesting company. Couple things I would like to see, obviously get that debt down or make an acquisition that makes a lot of sense for their company. And we want to see margin expansion. This is a company that doesn't have that great of margins when we compare them to their peers. And so we want to see margin expansion, maybe an acquisition, and get better return on their capital. But overall, I think it's priced depressed for a reason, because it's not growing fast, because they don't deploy capital well, and because the balance sheet is not perfect. As always, guys, appreciate your time. Hopefully you enjoyed this dive in, and we will see you in the next one. Peace.